Hello, Paul. Good afternoon. How are you?
Good afternoon, Theo. I'm very well. I can hear you loud and clear. Can you hear me okay?
Yes, loud and clear. Looks like very
Excellent.
interesting session today. Yeah, questions about price action. Successfully, you completed a variety of price action subjects. So well done. That's fantastic. And we see
Yep.
people,
And
they like it, they love it. They come on YouTube, they watch again and again, and new traders as well. So I'm sure
brilliant.
you add a lot of value to the participants and they show it with their participation on your webinar. So it's fantastic.
Yep. No, that's great. I appreciate that. Hopefully, it'll be something that gives people just a little bit of a chance to get their questions answered, and
Sure.
as also to be able to sort of just give them a little bit of insight based upon my own experiences of trading price action. So I look forward to it being a good session, Theo.
Absolutely. I wish you the best luck and I'll
Super.
talk to you
Thank you.
soon.
Cheers. Speak to you soon, Theo. Thank you. Good afternoon, everybody. Good afternoon. I hope you can hear me okay. I hope you can see the screen and see myself. Good afternoon and welcome everybody to the next in our Admirals Price Action Trading Guide series, session 50, ladies and gentlemen. Session 50. Here we are. And I thought that as we got to session 50, this was an opportunity really to open the door to yourselves, ladies and gentlemen. This is a chance to get some of your own price action questions answered. This is a little bit of an AMA with me. Ask me anything regarding price action trading today on here session. So it's great to have you here. Fabulous for you to join us. I appreciate that even though these are this is like the English speaking webinars, that actually what we have is that we have a truly global audience who join us for our sessions, and it's fabulous. Wherever you are in the world, you are very welcome here. Great to have you here, and I look forward to your interaction. As always, I also appreciate that we have a broad range of experience of traders who join us for our sessions, from complete beginners through to those who've been trading for a good while. And you are all welcome here. And hopefully there might be one or two pieces, even just for the old experienced traders, a few little nuggets of knowledge that you can take away and utilize in your own trading. So we'll do through the introduction here, but as I said, this session is really about getting some of your questions answered. So if you have had a few burning questions regarding price action, then here's your opportunity. Put it in the chat box that you have there, and in a few slides' time, we'll get to it. And we can have a conversation about price action. So feel free to get some of your questions and thoughts in that. Maybe it's something that you've struggled with. Maybe it's something you don't particularly understand, and you'd appreciate if I would take a moment just to re-explain it to you. Maybe it's something that you're just trying to sort of, develop and evolve as an experienced price action trader, and you just like some insight. Well, then, you're very welcome. You can ask away here. So by all means, ladies and gentlemen, say hello in the chat box and fire away. Not often I say that. So remember, here we are, Admirals, a Forex and CFD broker with global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products, and giving you the opportunity to engage with markets utilizing both the MT4 and MT5 platform, and also the Admirals Supreme Edition. So if you have any questions about Admirals, please get in touch with your account representative. They'll be very happy to help guide you. So what we talk about today, well, as always, we're going to be talking about price action trading, and we'll talk a little bit, okay? We'll talk a little bit about a recap of what we've learned so far and all the sessions that we've gone through. We'll talk about understanding traders' challenges. We'll have a little talk about that. And, I've got a couple of questions that people have already sent me through from the sort of feedback that we get at the end of each session. And then, as I said, a bit of a chance to ask a trader coach your own price action questions. And as always, we'll kind of filter that into having a bit of a look at the live markets. So for those of you who don't know me, still, you're just completely joining us for the first time. My name's Paul, traded for many years, traded for funds, traded for clients. Primarily, I like to focus on FX, indices, and commodities. Although I have had, experience of trading other asset classes, including with utilizing just price action, but those are sort of the three major ones that I tend to focus on for myself. I tend to be a trend trader for longer term trading, and I tend to be a mean reversion trader for my shorter term intraday trading, some of which we might have a little look at later. I would hope we're at session 50. So I would hope most people will have joined us for one or two of our previous sessions, or you've watched this on the Admirals YouTube channel. This series has all been about basically helping new traders just find a way to analyze and engage with markets using something as as simple and fundamental as price action. Because by understanding just a little bit of price action, understanding candlesticks, etc., being able to understand the sort of the merry dance that they play upon our screens in front of us, gives us an opportunity to analyze markets and then also engage them. So each Wednesday, that's what we've been doing. We've just been going through these sessions, helping you build up and understand your how to utilize price action in your own trading. And we've covered an awful lot, haven't we? So, and this probably comes into elements of today, namely that we thought that at session 50, this is an opportunity to just get people a chance to ask their questions, to get a little bit of insight and feedback. But we've covered an awful lot. And you've probably, if you've been joining us every week, you've probably heard me say that I try to cover the let's call it like the hard skills of trading. So things like setups, like you can see that session 2 we did engulfing candles. In session 4 we did star formations. All right, session 10 inside bars, etc. All those hard skills. But I've also tried to put in the soft skills as well. So things like preparing for opportunity. How do we manage our trades? Using checklists. How do we review our trading? These are the soft skills that completely new traders don't really fully understand or appreciate are important to you. But what I'm here to tell you is that the longer you trade, the more those soft skills actually become important in terms of helping you build a, let's say, kind of an overall successful trading business. So we've covered an awful lot, tried to mix a bit of both in. And as I said, today is all about you being able to ask some of your questions. Okay. So just a quick recap. Remember what we've talked about in terms of having a series of just a very simple plan, a simple process in order to be able to get new traders into the right habits, into the right routines, the right behaviors. Okay. And so what we've talked about is just very simple 10 steps. First step, okay, whenever you open a chart of anything, is that you define the levels of support and resistance. Doesn't matter whether it's euro, dollar, Bitcoin, gold, Apple, doesn't matter, okay? First thing you do, draw on those levels of support and resistance. Start the monthly, down to the weekly, down to the daily. Draw those levels in and get an understanding of them. Step 2, define, is there a trend? And you hear me say it every week. Good trends will leap off the chart at you. You don't need to force it. You don't need to push it in any way, shape, or form. The challenge we've got is that markets don't trend as often as we would like. They only trend maybe 20 to 30% of the time. But what we're trying to identify is, well, if there is a trend, okay, well, then, we want to be in a position to look at being able to sort of buy on pullbacks at support in an uptrend or sell rallies at resistance in a downtrend. And that's why it leads to step 3 is we're looking to see how does price react at those kind of key significant pullback levels. Because what we're looking for is step 4 is we're looking for some simple price action triggers at those key levels that gives us, the triggers for us to engage with markets. So those elements move covered, pin bars, engulfing candles, key reversals, okay, star formations, inside bars, just simple price action triggers. Step 5 is all about take a step back. Is it part of a bigger chart pattern? Maybe it's part of a flag pattern and a nice uptrend. Maybe we're buying into a double top, okay, at the end of a trend. We just want to have a look at the bigger chart pattern because either A, it might be a pattern you can trade yourself, or it might be just giving you a sense of a warning that we're coming towards the end of a trend. Then we've got the sort of what we call the 5 R's, all right? Step 6 was about risk, namely, you never trade without stop loss. You never risk more than a small portion of your capital on any one trade. In terms of risk management, you accept it and you manage it. The flip side of risk is step 7 is reward. All right, for when our trades, when we're fortunate enough to be right, okay, do we have a target that we're aiming for, or do we have a trailing stop? Neither is perfect. It's about which one can you consistently follow through on each trade for the next 20 trades as part of a sample size. Regardless of how you've traded it, step 8 is all about recording, okay? Great traders keep great records, and it's one of the ways that you can accelerate your own learning very quickly by ensuring that you're keeping good records. Because if you are keeping good records, then step 9 is that you need to be reviewing, right? You need to review your trades in order to improve. And if you've been doing step 8 and doing step 9, that leads on to step 10, which is about repeating, okay? Consistency and discipline are key. What we want to be doing is, it's hard to be consistent without being disciplined, hard to be disciplined without being consistent. What we want to be doing is we want to be repeating the good trades that work for us, the trade setups that resonate with us. And what we want to be doing is also is cutting out the sloppy, impulsive, off-plan trades, okay, that all traders will take. You're a human being, okay? You're a human being. You will make mistakes, okay? You'll occasionally get a little bit excitable, all right, and impulsive. That's okay, but if you're keeping records of these trades, you can start to see, these trends within your own trading. And as I said, what we want to do is repeat the trades that work for you, and then basically start to cut out, okay, the sloppy, impulsive trades that really don't help you. So there you go, 10 steps. That is not a panacea, okay, but it is a good framework for new traders to start with. If you're doing these 10 steps, you're making sure that you're doing the right behaviors, the right routines once you open your charts, okay, so that you're putting yourself in the best place possible to help yourself. And that's what we're looking to do with our sessions here. So I see there's a couple of questions in there and stuff there. What's going on? So fabulous. We'll get to those. That's brilliant. By all means, as I said, this is your chance to fire them off. And as the slide says, ladies and gentlemen, all right, it's our 50th session of the price action series, and we have covered a lot, all of which can be watched again on our YouTube channel, right? That's all there. Go into there, you'll find that they're all there. You can work your way through them. If there's ones that you've missed, or there's ones that you feel you need to go through, okay, then absolutely, by all means, make sure you utilize them. There's there, and then there's also, there's also other webinars and videos there from my colleagues here at Admirals, okay, Jens and Theo. You'll see plenty of their work on there as well. By all means, avail yourself of them. So I thought, as I said, 50th session, perfect opportunity to open the doors, allow you to ask a few price action trading questions. And what I always say is that at the end of each of these sessions, you should get through a quick feedback form. And we really do appreciate it if you just take the 60 seconds just to fill that in, because it's an opportunity for you to give us feedback. And as I always say, okay, we appreciate it all. And, if there's ideas or thoughts or concepts you'd like me to look at in the future, this is your chance to put that down, okay? And, we've enjoyed that. And I've added a couple of slides in just for a couple of questions that people have sent in recently as part of the feedback, and we'll use that as a way and a means to start our discussion for our AMA today. As I said, you're welcome to ask questions. All I ask is that just keep it within the remit of price action trading. Otherwise, we will be here all week. Okay, I could talk for weeks about trading. Okay, that's not the problem. It's more a case of that we only have a set small period of time. So let's try and keep them focused on price action and see if I can help you. And as I said, so it's your chance to fire away on price action questions. Okay, so there's one or two here and stuff already. So I'll just kick off those in case there's a couple of easy ones. So Eric says, do you consider candlesticks to be price action? I can answer that pretty quickly and pretty easily. Yes, I do. Eric, I would suggest that candlesticks are almost like the kind of the simple building blocks of understanding price action. And the thing I talk about with candlesticks is that candlesticks generally are a reversal pattern. All right, they are generally a reversal pattern. So you need something to reverse. What that means is that those candlesticks, they have their value at the end of a trend, and that trend, maybe that trend's months long, maybe that trend is 3 or 4 candles long. Okay, it can be defined differently depending upon the instrument and the time frame. But as a general rule, those candlesticks are a reversal pattern, which means that they need to have something to reverse, which also means that candlesticks in the middle of a range, okay, in the middle of a consolidation range, they're not massively helpful, all right? They're not massively helpful. They're just reflecting what's going on. Candlesticks as a reversal pattern, they need to be at the edges, okay? They need to be either at the edges of a consolidation period or they need to be at the end of trends, okay? That is where I believe they have value to you as a price action trader. So hope that helps you there, Eric. Good question. Good one to start us off on. Thank you very much for that. Serge, I hope I've pronounced your name correctly there. If I haven't, I apologise. Serge's question is: when there is big news, inflation data, etc., a big change can follow. When is the best time to enter the trade? So that is a good question, Serge. If you don't mind, I've got a slide. About 2 or 3 slides time, which was a question from somebody else, which was about trading news events. So if you don't mind, what I'll do is I'll cover both of those at the same time because they're very, very similar questions. But I'm very happy to help and stuff. Eric says, do you have a Bible for the definition formula for candles, especially pin bar? In terms of a Bible, as in a book that you could read, there is a book on candlestick formations, which gives you a fantastic information. And the chap's name is Clive. I can see his face. I've met him. I know the guy, but I can't remember. He's a very, very experienced analyst. There you go, Darshan. Clive Lambert. That's your man's name. I knew it there. It's just put on the spot. Clive Lambert. He wrote a book on basically price action candlesticks, and that as a introduction one is a good book. Okay, it's a good book. I probably have a signed copy of it somewhere here on my in my. I'm just looking at my some of my bookcases here. So he probably has it there. So thank you, Darshan. All right, but yeah, Clive Lambert's book on candlesticks. That is, if you want a good Bible that will just focus on helping you understand individual candlesticks to an even greater depth, that's a good one to start with, Eric. So I hope that helps you. So thank you for the question, and Darshan, thank you for bailing me out there. Thank you for remembering Clive's second name. Thank you very much on that. So we got there in the end, and that's the important thing. So we've got a couple of questions here from George. Paul, we've seen you don't use volume to consider trading decisions. One last comment about when, if any, you take a look at volume or volume not important for you. Many thanks. That's a good question. All right, that's a very good question, George, and I'll answer that now. You're absolutely right. You don't see me using volume on my charts as part of my trading decisions. That does not mean that I don't think volume is important or that volume shouldn't be considered. The reason I would look at it is that, or rather I don't look at it, is that as a general rule, my background and experience was in trading FX. And so when I worked at funds, when I've traded for myself, the volume that you get access to it's not the same as the volume you get for when you trade an index or when you trade an equity, where the trading has gone through a central exchange and stuff, and so there is a very clear, very accurate, mostly transparent record of the volume in that market. Because the FX market is it's an OTC over-the-counter market, there is not a central exchange for it. The volume that you were have access to is unless you're collecting that volume yourself, you don't really know where that volume's coming from. You don't really know how accurate that information is. So because I've come from that FX background, I don't personally particularly focus on using volume. As I said, that is not to say that you can't. That is not to say that it's not useful. It is immensely useful in many asset classes as a trading decision tool, okay, as a trading decision tool, but I generally don't use it because I've come from that FX background. So, and that's why. And also, I am happy in terms of my experience that in terms of analyzing markets, reading markets, I'm comfortable that I have enough information there to be able to make a decision on what I need to trade in front of me. I'm comfortable if. As a broader question about trading anyway, as a broader question, my view has always been that less is more. Okay, I want less things on my chart, more so than more, because human beings, we have the ability to basically to struggle. All right, okay. The more bits of data you have at you, the more likely you are to experience analysis paralysis, which means that you might hesitate when you're getting ready to put that trade on. So, as a general rule, I believe in less is more. And as I said, volume is because I've come from that FX background. So I hope that answers your question. It's a good one. Thank you very much for that. Paul says, do you usually close your price action trades before important announcements are published? Things like inflation, interest, growth, unemployment. Good question. Good question, Paul. And that flicks into kind of Serge's question earlier about sort of overall around about trading news information. And what I'll do is, if you don't mind, when we get to that slide, I'll cover all of that and talk about that in that sense. I hope that particularly helps there, okay, and that we can work with that. So yeah, let's go on. As I said, there's an opportunity for you to put a couple of questions in, so please feel free to do so. I'm here. I'll help as much as I possibly can within that remit of price action whilst we are here today. Oops. So what we're doing, as I said, I produced just a couple of slides, I think about 3-4 slides, based on some of the questions that I see reoccur on the feedback forms, okay? And as I repeat, you'll get a feedback form at the end of this session. I appreciate if you just take a moment just to fill it in and send it back. We always do appreciate it. But just a few questions that kind of keep repeating themselves. I thought that'd be a good idea for me to be able to sort of just take on board one or two of them and have a little bit of a chat through them, okay? And one of these ones was, how do I know which time frame is the right one to trade from? So we get variations of this question, and I thought this was an opportunity for me to sort of talk about that in terms of kind of almost like the macro level, but also on the personal level as well. So I'd have two answers to this, okay? So, it's not a case of me sitting on the fences. I'm just trying to look at it from the trading level and from the personal level. The first one is about which is the right time frame that suits your personality, lifestyle, and your trading experience. Now, I appreciate if you're completely new to trading, you might say, well, Paul, I don't have that experience to make meditations off, and that's understandable. What I normally suggest is that if you're just completely starting out, is that you start out at the higher time frames, all right? So I would be looking at things like the daily chart, okay? The daily chart, maybe the weekly chart, the daily chart. Why would I suggest that? Well, what generally tends to happen is that actually people decide they want to learn about trading, they want to engage in markets, they are enjoying learning a new skill, they're excited by the possibilities and the opportunities that it provides to them, and so invariably that kind of that excitement leads them to sort of normally sort of trying to trade markets they don't really know or understand at very, very short time frames. Okay, so you see them trying to trade on like 1 minute time frames and 5 minute time frames, etc. And that is not to say that you cannot, but what I can suggest is that things happen very fast, all right, on the 1 minute and the 5 minute time frame. And if you're still learning, still unsure about how to analyze markets, how to place trades in a market, how to manage risk, how to manage trades, etc., well, then things happening very, very fast mean that the likelihood of you making mistakes increases, the probability of it. Whereas looking at something like the daily chart, well, the daily chart is, it updates every day, okay? It means that you can do a little bit of time every day, okay? Rather than having to be sat there all day watching a 1 minute or a 5 minute or a 15-minute chart, what might be able to do is you might be able to just ring fence some time for yourself. So let's say, for an example, you say, Paul, I'll commit to 1 hour at the end of each day between 9 p.m., 10 p.m. in the evening after I've done my day job, after I've had my dinner with my family, after I've put my kids to bed, after I've sorted the house. I will give myself that hour in the evening where I will look at markets and look to trade. Okay, and that. Actually, for most traders, that is a better way to be doing an amount consistently every day, rather than just a little bit of time here and there as and when they can fit it in. So if you, let's say you do have an hour a day, maybe that's at the start of the day, maybe it's in the middle of the day, maybe it's the end of the day, you know, based upon what your own lifestyle is like. And I appreciate, as I said, people, you know, they have day jobs, they have businesses to run, they might have, you know, children to raise, they might have parents to look after, they might have other commitments, they may have disabilities, they might, you know, just live in areas where they have, you know, the sort of tenuous internet connection. We all have our challenges, all right, and it's about being able to work with that, okay? Because if you don't, if you try and say, right, I'm going to, you know, trade all day every day, or I'm going to trade here and then, what will happen is that you'll find it a challenge. So in a long-winded way, as I say, just basically pick something like the daily chart, commit to an hour of it, okay? You know, 30 minutes, maybe an hour of it a day, and then just be able to look at it. And because it's looking at it daily, you don't have to sit there at the moment, okay? You have time to watch trends develop, to watch trends end, to watch patterns develop, to watch patterns end. You have time to work out where your entry would be. You have time to work out where your stop loss would be. You have time to do your position sizing, time to do your analysis to work out where the trade may go to in terms of, you know, if you're joining a trend, etc. So things happen at a slower pace. And by doing so, you can practice ensuring that you have the right routines, the right processes to be able to do the right thing at the right time, and, you know, and get into a sort of almost like a groove of being able to do that. And then with that, once you have got that, you know, off pat and you're able to do it, you know, with competence, well, then is the time to maybe consider if you want to trade sort of faster timeframes, you know, because you'll have had a bit of experience of it. So as I said, if you're new and you don't know it, that would be my suggestion. You know, furthermore, lots of traders are looking at the daily chart, so moves tend to become self-fulfilling prophecies on that. And I'll add with that is there's one that allows you to have a mix of multi-time frame analysis, and we covered that last week. How to incorporate multiple timeframes and price action. So that should be on the Admirals YouTube channel. If you need a reminder, if you want to watch it again, it's in there. But why does that mean? What does that help? Well, sometimes you know, I find new traders, they think they have to be doing multiple time frame analysis, but they don't really know how to do it. So they try and cover all the bases by basically covering all of the charts. Okay, so they'll look at the monthly chart, the weekly chart, the daily chart, the 4 hourly, the 1 hourly, 30-minute, the 15-minute, the 5-minute, the 1 minute, and they get completely confused about trying to work out, well, how do they all work? How do they connect? Do I have to wait for every single one of these timeframes to line up? Because if you had to, you'd be waiting probably a very, very long time. All right. What I want to do and what we talk about is just keep it simple. Have a bit of a combination, and this kind of leads on from the answer to the first part, is that if you have, let's say you have do most of your work on the daily chart, but it might be that the daily chart becomes your execution chart, but you can have a higher time frame chart as your monitor chart, as your analysis chart, the chart you look for to identify trends. So in which case, maybe it's the monthly chart or maybe it's the weekly chart, okay? So that means the weekly chart, you can do a little bit of time at the weekend, okay? When the market's closed, all right? Just do a little bit of analysis, but just doing the price action, just following those 10 steps we talked about. It means that a little bit of time at the weekend, okay? Off the market, you can do your analysis, you can start to identify areas that may become of interest to you during that week, and then you can execute it on your daily time frame where you're doing just your daily work. That way you're complementing each other without overcomplicating it, okay, without exposing yourself to far too much data, far too much information. Because the more data, the more charts you have, the more timeframes, well, then it's just easy to become overwhelmed. It's easy to have that analysis paralysis, which means you just do nothing because it's too much, or you go the other end of the extreme and you start just mashing keys, and because you just don't really know what's going on and you're looking at it. So as I appreciate, that's a bit of a long-winded question in terms of which is the right time frame, but as I said, to start with, slower tends to be better. All right, get yourself a bit of experience, get yourself a bit of an understanding how to use the platform, even how to place trades, how to manage trades, and only then maybe consider moving down the timeframes if you feel that that's where you'd like to operate, okay. Some people are drawn towards trading short time frames. Other people are not. It's part of it is about understanding your own personality. If you are let's say if you're a very nervous person, if you're a very anxious person, if you're a very risk averse person, well then trying to trade something like the NASDAQ on the 1 minute chart during its opening 30 minutes, is probably not going to be the right instrument, the right time frame, the right style of trading for you. All right. It's about knowing who you are. Everybody can find their niche. Okay. It's just part of it is knowing who you are, knowing where your strengths are and what your weaknesses are. None of us are perfect, myself included. We all have our strengths and weaknesses. It's about understanding what your strengths are and leveraging them, and then understanding what your weaknesses are and mitigating and finding tactics to be able to put in place to keep them keep them within their box, and doing that in terms of being able to allow you to operate effectively as a trader day in, day out. I think I had an example of one of my own examples here. So it's one of my own examples here. Just have to excuse my scruffy charts, okay? So this is talk about multiple time frames. This chart here on the left is that's cable. So I trade a lot of sterling. Sterling has always been my baby when it comes to the FX markets. Okay, that's always what I've particularly looked at. This is here. Just excuse my. I always say excuse my drawings on the chart. I'm a better trader than I am an artist. All right, you'll be pleased to hear. So for me, I use the weekly charts there to give me a course of direction. And so for pound against US dollar, what we've seen over the last couple of months is that once we'd hit this big round number, remember we sort of talked about that, making sure you're aware of them on the charts, big round number 130, we had a twin towers inside bar there. And then what we have seen is we have seen an element of sterling weakness and dollar strength over the last couple of months. And that's been reflected in the pound against dollar dropping. And then, you can probably see for yourself that, we were just working our way down, and then we had a very strong week, okay, a very strong bearish week, just basically further enforcing what I was looking at. And then the week after it here, okay, 2 weeks ago, we had a candle which was it's an inside bar. It's also a bearish pin bar. And so price had tried to rally up during the week and had been pushed all the way down. Okay, and I was expecting that invariably what we'd see for the next couple of weeks was that we would see the continuation of sterling weakness, dollar strength. So that downtrend was likely to continue. So that was my trend. That's what I was looking to do. I don't want to fight trends. Okay, I want to surf them. I want to ride them. And so I do a lot of work on the 4-hour chart myself because I trade most days and stuff. I have the ability to basically just watch when the 4-hour candles complete and start. And this price action here, that price action here, okay, there's basically push up there, and then that drop during that week. Well, that was, let me clear these down. This candle here, push. Okay, is this on the 4-hour chart, which is basically the big move up followed by the big move down and it closing on its lows. All right, and that is what gave me that inside bar bearish pin bar. So I want to be short this. I've already said I've got my plan. I've done that. I want to be short. Okay, the cable on pullbacks, and then what happens is on the start on the Monday, about in early Monday afternoon, price pulled back, and then what did it do? It hit the 50-period moving average and printed for me a nice simple bearish pin bar. Okay, and that was my trade. And my trade was down towards the basically the lows of August. Okay, that's what I was looking for. The yellow dotted line is the lows of August, and that was my trade towards there. Okay, which we hit nicely. The price actually went much further, but you don't know that at the time. All right, it's easy in hindsight to say, oh yeah, I got into the highs and got into the lows. That's nonsense. My plan was basically as it pulled back, okay, hit the 50, printed me a bearish pin bar, okay, which is just a simple price action tool. Right, my trade was down to the recent lows. Okay, that was what I was looking for, and that's where we went. Now, at the start of this week, okay, basically what we did was, we basically ended up printing that further bearish candle, which is this 4-hour price action here. So I'm still going to be bearish sterling, bullish dollar, okay, and what we had was we had exactly the same thing happen again at the start of this week, namely that we had basically a pop up there like we had done, okay, at the start of last week, and then that was basically ended. And what was it ended by? It was ended by a bearish pin bar once again off this the lows of August. Okay, what was support here? Okay, what was support here suddenly turned into resistance. And this is why I talk about drawing in levels of support and resistance on your charts. Okay, markets remember them. Okay, markets remember them. All right, it's and what we're looking for is the confluence of events. We're looking for 2, 3, 4 things come together one time and place that allow you the opportunity to give you a trade opportunity. And that was once again just my simple kind of like Monday afternoon trade. Okay, as we've moved our way down towards there. So that was, I just wanted to share like a simple example of of answering the previous question, how I turn it into my own little plan. Use the weekly chart to just give me an idea of the direction, and if there's any price action that is giving me a hint of where the higher probability move is, and then I can drop down to the 4-hour, my execution chart, and I'm ready to sort of execute my trades on that as and when and if, because they don't always, if they set up for me. And that's what we're looking for there. So I hope that answered that question for people. Eric says, do you use any scanners? I do. I have a couple of proprietary ones that help me, okay, that I've built myself, but that is more about not necessarily scanning for setups. It's more about it scans all the markets in the FX world and then gives me an idea of what the environment is, okay, is I'm going to be bullish, I'm going to be bearish, where is the strength and where is the weakness within the FX market, and that is enough for me to basically identify the environment, and then I'm looking to hone in and just trade price action in the direction of the trends. And within FX, as I said, I want to be buying strength and selling weakness. That's what I'm particularly looking at. So good question. Hope that helps. So here's another question that we've had from feedback, which also feeds into a couple of the questions we've had here today, I think from Paul and Serge, etc. Paul, how do I trade news events? So if you want to learn more about it, then be sure here, sorry, it's right at the bottom, I should have moved that, is section 37. We specifically talked about how to trade news events. So there is a complete video just on that. So by all means, be sure to check that out. So in terms of trading news events, I could talk all day about that, all right? So I'm just going to give you some very simple suggestions that you can take away based upon my own experience of, trading for funds, trading generally day-to-day, and also coaching and mentoring traders, for many years. And here are my suggestions. First one, do not trade in front of news events. All right. What that means is that you just try and put a position on just in front of the big news. So this afternoon, okay, at sort of 1:30 UK time, 8:30 US time, we had the US CPI data coming out, and I think that's the big news release of this week. All right, which one lots of traders have been looking at and interested in. But what I'll be saying is, don't try and trade just in front of it. Okay, sometimes new traders think that they can get ahead of the crowd. Okay, by basically putting on their position just a couple of minutes before that news is released. That is probably not going to likely to work out very well, because big news like that has all sorts of volatility induced from it. Okay, because there are just multitudes of players for multitudes of reasons, either getting into positions, getting out of positions, getting stopped out of positions, hitting profit targets, etc. There's all sorts of volatility there. So don't try to trade in front of the news events. Secondly, don't try and trade at the news events, all right? And what I mean by that is, you think that, CPI is going to be less than expected, which means we'll be good for for stocks and poor for the dollar. So at the news event, I'm ready to be bearish, ready to sell the dollar, and as soon as the news comes out, I try and just hit the button and sell that. If you'd had that plan, you'd have had the wrong plan, because actually CPI news was high as a second monthly bump, okay, after declines, all right. But also just trying to trade at that, you are, in my book, you're not trading, all right, you're gambling, all right, you're just taking a punt, you're just a flip of a coin and a punt, okay, and that's not a smart way. So trying to trade in front of news events or trying to trade at the news events is not a smart way to operate, ladies and gentlemen, all right. because good traders, experienced traders, will often know that the first move may well be the false move. All right, the first move may well be the false move, and I'll show you from my own trades this morning, okay, and how that played out. My suggestion when it comes to around trading news events is wait 5 to 20 minutes after the news, let the kind of volatility subside a bit, and then what very often you'll see is then you'll see the real trend start to develop. And that might be 30 minutes after the news. It might be 24 hours after the news. Depends upon how important the news event is and how, let's say, seismic the news was in terms of, was the news very different from expectations, in which case it may well have been a game changer. And so it might take 24 hours for the big institutional players to either trim positions, maneuver positions, okay, into what we see as the new direction. So if you have a need to trade news events, all right, I generally don't, okay? I don't generally specifically target news events, okay? I'm happy to trade after them just as part of my normal if it comes into the hours of my normal sessions. But if you have a feeling, I say, don't try and trade just in front of it. Don't try and trade at the news when it's coming out. Let the market have 5 to 20, maybe even longer, 30 minutes to allow you to see what actually is occurring. So you're in a position to make, a better trading decisions once that's happened and once that has occurred. Philippe says, how to prevent false breaks. We might come to that in a moment, if that's all right, Philippe. It's a good question there. And Haristians asked me a question. I'll answer that in a moment. I apologize if I've pronounced your name wrong. That is all mine. So yeah, that's my kind of suggestions on news events. Here's this morning, okay, my trades this morning. So as I said, I trade a lot of sterling. That seems to be my preferred asset class. So I have a profile. Sterling profile says pound against dollar, euro against sterling, pound against Aussie, euro against pound against Canadian dollar, pound against yen, pound against Swiss franc, pound against New Zealand dollar, FTSE. All right, there is bang in front of me. Bosh, there I have just a profile there that gives me a view of all of the charts of the sterling pairs and the FTSE. Those of you who've been covering will know that yesterday we had news out in the UK in terms of the jobs and wage growth. Wage growth was very high. Today we had GDP. The GDP numbers were pretty poor. All right, I think it was about a 0.5% drop. And what we can see here is basically the grey boxes are the Asian session. Okay, that's the Asian session. And as the news came out 7 o'clock this morning, bosh. All right, you can see that that's where actually the price just euro sterling so will be different. But you can see on that bad news, price dropped. Okay, price dropped, and bosh, that's the way it goes. And it's actually here where I start to get interested as a price action trader, is that, let the news make its move. And then actually, remember what I said earlier, is that very often the first move can be the false move. So yes, it has moved down here, but then actually what we saw here with cable at the previous week's low, yesterday's low, that is where actually we put in this nice bullish key reversal pin bar. And that was my trade back up into the range. Did the same on the pound against the Japanese yen. Trade back into the range, okay? Did the same, okay, on the pound against the Swiss franc, right? After about half an hour after the news, it reversed and moved. Did the same on the euro against the sterling, okay? It did the same on the pound Aussie, but the Aussie and the Kiwi have strengthened a little bit this week, so their moves back into the range weren't that strong, but it was for the Canadian dollar, okay, the pound against Canadian dollar, and FTSE, okay, FTSE dropped as well. So there's an example just from this morning, namely that the news came out. Okay, I wasn't trying to trade in front of it, wasn't trying to trade at it. Let the news come out, let the market make its first move, because very often, not always, but very often, the first move can be the false move. And then as I see a reversal which fits into one of my overall trading strategies called the Pac-Man, all right, and then basically then I see it reverse and work off there. And that is my trade, okay? But those trades weren't until 30 to 90 minutes after the news had occurred, okay? So when it comes to news, that's the way I like to particularly to look at it and think of it. So just one question was who's just trying to find it here. Time flies when you're having fun, doesn't it? Felix says how to prevent a false break. Well, my view is, and this is my view, is that markets, most trading strategies boil down to either a bounce off a level of support resistance or a break of a level of support resistance. As a general rule, I don't like to trade breakouts. I like to trade bounces. And the reason I trade bounces is because I think in the FX markets, there are an awful lot of false breakouts. So whereas, Philippe, you're trying to prevent a false breakout, I'm the guy on the other side looking to trade that false breakout, to see a breakout come out and it falter, and then basically for it to fall back and revert back into its mean. That's my trade. I love to trade a false breakout. For yourself, if you're new and looking to try and trade a breakout, there are several ways of saying. One, just you can wait until actually the price is closed beyond the other side of the breakout, and enter then. That means your reward to risk is probably going to be skewed. Okay, you're going to take on a little bit more of the risk, but the equal side is that it's less likely to be a false breakout. Secondly, what you can do is if price does break out, you can wait to see if it comes back to retest the breakout level, kiss the trend line goodbye if it's a dynamic one, before it moves in. Okay, so there's that. You can either wait till it closes the other side, wait till it comes back and retests the breakout line. The challenge with waiting for the retest is that sometimes that breakout will be super strong and it won't come back, and that means you'll have missed it. So there's no perfection. It's about finding a way that you can work with. Aristin says, what's your experience with Forex sentiment? For example, IG, Daily FX, and my FX books have such indicators on their website. I can understand that they are interesting, and I can understand that they're important, and sentiment analysis is very helpful, Aristin. My question would be is, how have they created that indicator? All right, how have they created what actually goes into getting that data? Putting a few squiggly bars on a chart on a web page, that's fine, but actually as a trader I want to know, well what was the data that went into that? All right, what is the data that went into that? That's what I'd want to know. And so my view of that would be, unless it's your own data, unless it's your own indicator, okay, they can be helpful, but really learning price action will in its way give you an indication of sentiment. And what I talk about, and I think we covered it in one of the early sessions, is that even if you can just understand, are we in a risk on or a risk off environment, that is a great way to understand the sentiment and the narrative that is in play. And I'm pretty sure that I did one of our sessions was on understanding risk on and risk off environments. Okay, so be sure to watch that. If I haven't, I'm going to check after this, and I will definitely put it in for one of our future sessions to go through. So that would be my answer on that. Quickly, because I appreciate time is of the essence. We're running over a little bit, but there you go. I try to fit in as much as I possibly can. One of the other questions is that Paul, there are so many instruments to trade with Admirals. All right, where should I focus? And that's true. Admirals provide a fantastic range of instruments that you can trade, but if you're a new trader, sometimes maybe it's a little bit overwhelming. All right, and so what I suggest is that basically start, just basically narrow in a little bit, and then you can develop that based upon your experience and also that previous question about understanding what fits in with your lifestyle, okay, your other commitments, your personality. My suggestion is start with an overall market monitor profile. All right, just have a profile on on the MetaTrader 5 and 4 here that you get from Admirals. In terms of, I'll show you. You can have 4 of your indices. I would have the 3 Americans, the Dow Jones, the Nasdaq, S&P, and then I would have the DAX, if in Europe, because DAX is the major index, okay, for Europe, and if not DAX, then the FTSE. But then you can also basically amend that to wherever you are in the world. So I appreciate we've got people here from Australia, okay. Then by all means, feel free to put in the ASX. Maybe you're watching this in other parts of Asia, okay. You might want to put in the Nikkei, okay, if you're based in Tokyo, all right. Or you might have there might have variations in terms of local indexes based upon where you are in the world. But I would have that because that will give you an indication. Commodities wise, I'd have US oil in there, and I'd have gold as commodities. Okay, you can get an idea of them. And then to start with FX, just have the dollar index, okay, and euro dollar. Euro dollar is the flip, okay, the inverse correlation between Dixie and euro dollar. But what it can do is just give you an indication the euro dollar is the most liquid traded product in the world, from my understanding. Okay, so that would just give you a starting place, and then you can develop out based upon what you're looking at. So as I said, other instruments based on your focus, personality, and trading style. So I took a bit of a screenshot here. So we've got Dow Jones, S&P, Nasdaq, DAX. Okay, all in the daily chart, all showing a bit of a squiggle there, aren't they? There you go. That's all a bit similar. That's the way we work. Gold and oil. So we can see oil has been in a good uptrend, gold in a downtrend. A lot of that has got to do with the fact that dollar index, dollar has been in a strong uptrend, which means that euro dollar has been in a downtrend. Very quickly, I can look at that, that kind of market monitor profile, quickly understand and basically develop an idea about what is the sentiment. We had a question there before about it. Are we in a risk on or are we in a risk off environment? Is the dollar strong or is the dollar weak? If we can understand what the dollar's doing, well, that gives us a hint in terms of what things like commodities like gold and oil, etc., are doing. We can start to build out a picture from that just based on there. So that's how I would answer. That's how I'd particularly answer that. So there you go, ladies and gentlemen. I appreciate we're overrunning a little bit, but as I said, this was our 50th session on price action trading, and it's a chance to discuss your trading with a trader coach. That can be very beneficial. That can help you. Overall, when it comes to price action trading, have a plan. All right, and we've done sessions on having a nice plan. Follow that plan. Follow your process. Ensure that you manage risk. Manage your trades correctly. And what I mean by that is, once you've got a plan the trade the plan, and think in terms of samples of trades rather than just one single trade. Sometimes new traders, they get very, very focused on each individual trade. They're excited. It's a new endeavor. They're enjoying it, and they're desperate to win and succeed on each trade. But actually, what you need to do is thinking about, this is just one of a sample of 20 trades, 50 trades, 100, 200, 1,000 trades, and then you're getting into a point of just thousands of trades. Do that so that you're in a position to actually enjoy the journey. Before we finish up, just a reminder that the next of our session, which will be session 51, it won't be next Wednesday. Just Jens and I have had to swap. It'll be next Friday, 22nd of September. Put it in your diary, because what we're going to talk about is how to understand price action and also the smart money concepts, SMC, which is very popular with lots of, let's say, YouTube traders these days. So we'll just talk about where and what a price action SMC, how are they different, how are they the same, how can you utilize them together, can you create a trading plan that utilizes both? So that might be a very useful, interesting session for you. Next Friday, 22nd of September. Check your inbox for the webinar link, or head over to the website to be sure to sign up. And as always, if you've got any questions or comments, then by all means, you can send them here. There's all manners of ways you can get in touch with us. You're very, very welcome to. As I said, there will be there'll be a feedback form at the end of the session. If you took a moment to fill that in, we'd really appreciate that. It's your opportunity to tell us if we're doing right, and also if there's concepts or ideas you'd like to see me cover in the future, just put it down there. I'll quite happily take on board. We want these sessions to be as beneficial, as useful as possible to you. So there you go. I think, unfortunately, we're probably not going to really have time to look at live markets today because we've tried to cram in so much, but hopefully you got an idea there from those questions, even just looking at some of my examples, from the last couple of weeks and from this morning's tradings in terms of, what price action can bring to the party for you. So yeah. So I hope that session was very useful. It gives you an opportunity, as I said, to ask us a few questions. If you find that useful, then we can plan them in the future. Just by all means, just be sure to put that into the feedback form. We're very happy to do that. And as always, just remember, as you always hear me saying, regardless of whatever type of trading you're doing, plan your trade your plan, manage your risk. Those are the three things that are within your control, and those are the three elements that you should be focusing on, making sure you're doing sort of session after session, trade after trade, because that is what will actually help you the most in terms of your trading journey. So with that in mind, it just sort of just left for me to say that thank you very much for joining us. Thanks for those of you who either sent in questions beforehand, or thank you for those of you who've asked questions throughout this session. I hope that has been helpful to you to get a chance to have them asked. Eric said I didn't catch Clive, so it's Lambert. I think it's Clive Lambert is his surname. What I'll do is I'll actually afterwards I will find it, and I'll find the book, and I'll put a link up, okay, whether it be on our Telegram page or etc., just so you can see that and watch that. But as always, I hope you found that useful. I hope you have a fabulous trading week, everybody. I hope you have a great trading week ahead. As I said, the next session next Friday, 22nd of September, on price action and SMC. If you're interested in that, then by all means give us a shout, and I'll look forward to seeing you join us there. Take care, everybody, and trade well. Cheers.